You might remember me telling you that I would put together a couple of models and explanations so that you can better understand how we go from free cash flow, or our typical cash flow component when we're trying to value a business, to seller's discretionary earnings. And we kind of go there through a tax-adjusted EBITDA. So I'm going to spend a few minutes in doing that. And then I'll also go ahead and take a look at how we look at a net tangible assets model, which is kind of a takeoff of the blue sky model that you're aware of, and how we might apply that to firms outside of those that were intended for the blue sky. And the blue sky, of course, being intended for firms in the auto dealership and tractor dealer and heavy equipment manufacturing dealer industries. So we're going to go ahead and look at both of these over the next little bit. And I hope this will give you a better sense of clarity with respect to this as you're preparing your valuations for the valuation report. So I'll go ahead and share my screen, and we'll begin to work through this. I'll go through and not only show you the material I put together, but I'll also show you a spreadsheet for a subject company by the name of Autumn View Associates, which is an LLC and has some interesting SDE, or seller's discretionary earning adjustments. So as we look at this, we're going to obviously go from FCF to SDE, just like I said. We're going to look at a net tangible assets model, which again is really just a takeoff on the blue sky multiple model, but it lets us bring into the valuation of a firm, not only the valuation as a function of its cash flow or market comps, but also the net tangible asset value of any high valued inventory or valuable non-depreciating real estate. So we'll look at that. First, let's talk about going from free cash flow to seller's discretionary earnings. To do this, we're going to create a valuation first based on discounted cash flows, and just come up with that basic FCF model and consider what it will do for us. But we have to think about, how do we calculate free cash flow for a small business? Remember that small businesses have problematic balance sheets for many reasons, including sometimes the balance sheet isn't properly accounted for. In fact, even when the income statement is properly accounted for in a small business, very often the balance sheet is not. So that's a problem for us to begin with. And we can't count on accurate balance sheet values. We can't count on accurate invested capital. We can't count on accurate changes in fixed assets or changes in net working capital, which, as you know, of course, are the components of two of the richest parts of the free cash flow equation. We also know that oftentimes small business owners will run personal expenses through the income statement. And when they do so, they're being smart in terms of tax savings, but they create a paper trail that's not necessarily all that favorable to trying to value the business. When they've overstated the business expenses by including some personal expense, what they're doing is understating EBIT and then driving down the value of the business if we're simply using EBIT as we find it on the income statement as one of the primary inputs to our cash flow equation. Finally, we know that very often business owners, small business owners, will not appropriately account for their own wages. Sometimes they're spot on. They pay themselves through the wage and payroll categories. They pay themselves an appropriate market wage. But more often than not, they don't. And it's probably split between where they underpay themselves through that category and then maybe either take distributions out of profits or just live on the meager amount that they do pay themselves as the business is up and running or as they're getting it going. Or sometimes they overpay themselves because they've got a nicely profitable business and they pay themselves more than they could expect to make anywhere else in the market. So we have to think about making adjustments for that. We also might have to think about making adjustments with respect to rent if the business owns its own property. And so we'll look at that as we go through these. So because of these necessary adjustments for small businesses, more often than not, small business valuations, certainly when considering a discounted cash flow, are going to use seller's discretionary earnings as the cash flow variable rather than free cash flow. So here's my question. Is SDE, or seller's discretionary earnings, the same as free cash flow? And are they the same as a tax-adjusted EBITDA? So let's consider the free cash flow equation. So free cash flow is equal to no plat plus depreciation minus change in net working capital minus net capital spending. And we know that those last two components, change in net working capital and net capital spending, are balance sheet components. And we know that that's challenging for a small business to have appropriate balance sheet components. Not only do many small businesses not have any assets on the balance sheet, which means they also don't have much of any depreciation at all, but to the extent that they do have assets on the balance sheet or depreciation represented in the income statement and the balance sheet, then oftentimes they're misstated. Because whomever is doing the bookkeeping may not be as up to speed on how it should be accounted for. So because of that, we have a hard time relying on those elements. So we're going to think of them as being held constant, which means we're going to think of them as being held equal to zero, which means that our free cash flow equation now goes from no plat plus depreciation minus change in net working capital minus net capital spending, and it moves to that equation from free cash flow equals no plat plus depreciation. Now, frankly, those other two elements are there. They're just at zero, so they fall out or they disappear. And we know that this is going to be the same as EBIT times 1 minus a tax rate plus depreciation. And we'll call that a tax-adjusted EBITDA. Now, frankly, we know that it's not a tax-adjusted EBITDA. We know that it's really a tax-adjusted EBIT with a depreciation and amortization kicker. But commonly, we refer to it as a tax-adjusted EBITDA. Well, what tax rate are we going to apply? Most small businesses won't pay tax or income tax at the business level. Most of them are organized as proprietorships, sometimes partnerships, sole proprietorships. Other times they're organized as LLCs. And in each of these cases, if there is an income after all expenses, both operating and not, so what we would otherwise think of as a taxable income, that then is passed on to the stakeholders, the partners, the proprietors, proportionately based upon the stakes that they hold in the entity, and they would pay tax on those incomes at the ordinary income tax rate. But the fact that it's organized as a proprietorship or a partnership or LLC is a discretionary choice on the part of the business owner. And we know that we shouldn't allow to enter into the valuation equation or any of its inputs any elements that are exclusively a function of discretionary choices. So because of that, even though we know that most LLCs, proprietorships, etc., won't pay tax at the business level, and even if they do pay tax, it's going to be at the owner's level, which may or may not be a significant level. It may be very small if it's a small income owner, or maybe very high if it's a high income owner, but they'll be paying taxes at the owner's level, not the business level. But regardless, we're going to use the tax rate on EBIT, just as we've used for any of our other valuation modeling. And in most states, that's going to be approximately 26%, 21% federal, and about 5% state. So that's the only tax rate that we can count on here that isn't influenced by discretionary choices made by our business owners. And we'll use that as we consider the free cash flow and as we consider these SDE equations. So to start this then, we're going to start by adjusting the company's EBIT. We're going to look at the EBIT that exists, and we're going to put back into it expenses that should have been there, take out of it expenses that shouldn't have been there. So I'm going to give you an example, a company by the name of Autumn View Associates. And Autumn View is an interesting little company. They have an active consulting practice, but they also sell some hard goods. They're in the technology space. So one of the things that we know about Autumn View is that about $12,900 of expenses that really should be the owner's expenses that they would be paying for themselves, but are running them through the business because they believe they can. So that's overstating operating expenses and understating EBIT. So we're going to back those out of the operating expenses. We also recognize the operating expenses don't include any rent because Autumn View happens to own its own building. And it's not owned by the partners necessarily. It's owned in the Autumn View space. And so we have to think about the effect of it not paying rent. Well, we don't get to deduct any mortgage payments that they might make, other than perhaps interest, but we don't deal with interest when we're looking at the free cash flow or the SDE equation. So we've got to go ahead and identify an appropriate market level of rent for the building that they're occupying, and we're going to include that as an expense. And then if necessary, we're going to take away from the operating expense category on the income statement any expenses they paid that they wouldn't have paid had they not owned the building. Things like taxes for the building, maybe repairs and maintenances for the building. We're going to keep it simple in this example, so I'm only going to make the adjustment for rent. But recognize that rent is the cost of being in the building for a tenant. And we are going to always suppose that businesses are renting their space, unless the business is a real estate business or a real estate holding company. Because otherwise, owning the real estate isn't really an operating asset. It's an asset that they have chosen to acquire as a store of value, or perhaps as something that they would like to have an increase in capital gains over a period of years, as they believe that real estate is going to increase in price. But if there's a piece of real estate there, and it's got both land and buildings and probably fixtures and furniture in the buildings, then maybe there's some depreciation we have to think about adjusting away as well. So in this case, we're going to make the assumption that Autumn View should be paying about $18,000 in rent on the open market for the space that they're in. That's not a lot, but they're not a big business. And that they're showing on the income statement under their depreciation category about $10,900 in depreciation on that owned property. Finally, we're going to recognize that Autumn View's owners pay themselves in part through the wages and payroll line on the income statement as a operating expense, but they don't pay themselves a market wage. If they were working for another company in the open market, they'd be earning about $40,000 a year more than they're earning now. So we're going to have to put that expense into the operating expense category, because if they didn't own the company, if someone else did, expressly a passive owner, they'd have to hire someone to take care of the business. So let's take a look at how this works for us then. So what I'm showing you here is a pre-adjustment income statement for Autumn View. It's in the black font, and then an adjusted income statement for Autumn View in the blue font. And I'm showing you here on the right some of the adjustments that we made. So let's see how these affect us. You'll notice that we haven't made any changes in sales, because none of our adjustments that we just talked about to get to seller's discretionary earnings had to do with income adjustments. But there are operating expense adjustments. You'll notice cost of goods sold is the same for each of the two scenarios, adjusted and, or rather not adjusted and adjusted. Wages have been changed though by the $40,000. So we've increased the overall wage expense by the $40,000 that these owners have not been paying themselves. And by the way, the scale on this is all in thousands. So you can see here, I've got my adjustment dollars, but I've divided them by 1,000 because the scale on this whole thing, including the balance sheet that we might take a look at a point, is in thousands. So I've gone ahead and increased the wages category by the 40,000, and then I've gone ahead and added a rent category. There was no rent category initially because they weren't paying rent to the building that they owned. And so I've increased that by the $18,000 for each of the 2 years that are the subject years in our example here. I've gone ahead and reduced depreciation, which was running at 13.64 in 2018 and 13.89 in 2019, and I've reduced those each by the $10,900 depreciation adjustment. Again, this is depreciation that was associated with the building that they own, that they're occupying, but that they're not renting. So if you think about it, rent expense that is charged to a business includes many things, amongst them being the depreciation of the building. So that's how we recognize the capital cost of the building as we move through time. So we've gone ahead and changed this at the $10,900 level. And then finally, we've gone ahead and made the change for the wages, I think, as I represented up here just a moment ago. So we've got a number of changes that have taken place here. And these are not trivial. We've got to make sure that we're paying good attention to this. I think I bypassed the owner's expenses in S&A. So the sales and administrative expenses that we see here for 2018, 2019 are much higher than the ones we see under the adjustment. And that's because we've backed out of them the $12,900 owner's expenses. So we end up with a very different operating expense line here, much higher as it turns out than it was in the unadjusted statement. And so we have adjustments up and we have adjustments down in this based upon the adjustments we're making, and we end up with a much different EBIT. So our 2019 EBIT before the adjustments was 286.79, and now after the adjustments, the operating expense is 320.99, which then of course gives us the opportunity to create an adjusted EBIT. And the EBIT was 228.45 before the adjustments, and it's adjusted down to 194.25. Well, think about this for a moment. If we were simply going off of the income statement as it was stated by the owners and before the adjustments that we've made so that we could get to sellers' discretionary earnings, then we would be overstating the EBIT, and we know that overstating the EBIT is going to overstate the discounted cash flow, and it's going to overstate any multiple-based valuation we do as well, because EBIT is at the heart of any of the cash flow variance in any of the enterprise value multiples that we use, except for possibly simply the enterprise value sales multiple, which for a company that has good earnings, that has a track record this does, the length of time that this has been in business, we certainly wouldn't use that kind of a multiple. Well, we go on then to continue with interest paid and taxable income and such, but interest paid, we haven't made any adjustments, of course, because it's not relevant to our SDE consideration. Taxable income, we've come down, and I'm showing here that we've got some pretty meaningful differences because of the adjustments made in EBIT. But again, that's really not going to affect us when we think about the SDE equation or the multiples form of valuation here. But I went ahead and represented them anyway. But notice I've represented as zero taxes paid because taxes aren't paid at the company level or at the firm level with most small businesses that are organized as partnerships, proprietorships, LLCs. Now, were this business a C Corp, or were it treating itself as an S Corp paying taxes as a business, we'd see taxes paid down here. But once again, it's not going to have any effect on the valuation that we do because we're not doing an adjusted present value evaluation using a tax shield. We're just going to do a cash flow valuation with SDE as the cash flow, and we're going to think about then a multiples-based or a market-based valuation. So as we move on, we can look here and say, well, how is this tax-adjusted EBITDA or SDE? So what I've done is I've adjusted EBIT for seller's discretionary items, and that's giving me the adjusted EBIT. And then I take that adjusted EBIT times 1 minus the tax rate. I add back into it depreciation, and effectively I've created that tax-adjusted EBITDA. And in so doing, I then end up with a SDE of 146.83. Now you're going to see in a few moments when we look at some things that might be meaningfully different than free cash flow. So we've got to keep that in mind, but that is the reality for one of these businesses where we can't project the balance sheet of the income statement. So this is important to us. Now also, it's going to affect how we look at the multiple because we're not going to look at a free cash flow multiple, of course. But what we've done is we've taken and morphed the small businesses income statement and balance sheet, or especially the income statement, to something more credible and that would pass audit and pass GAAP perhaps.